I am the Giveback Realtor, Stephen Saunders, here today to talk with Kim Patterson from North Point Bank. We are going to be looking at creative financing, the options, the risks, the caveats, the legality even. So let's get into it. Kim, welcome to Industry Chats. All right, so before we continue on with our conversation, I just want to tell you a little bit about the Community Giveback Program. And I just want to talk to you briefly about what it is. So at the end of every transaction, I give back between 5 and 50% of my net income to the community. 20% of that is client directed, which is awesome. Look at these two recent closings. We ended up writing a check to the NROTC and to the Bright Side Animal Center in Redmond. Those were client-directed contributions to these community charities. The remaining 80% of charitable funds are directed by you, my clients, the community, local artists, educators, charity volunteers, all of the stakeholders in our community have the opportunity to vote on where funds should go. So this is what's meant by the Community Giveback Program. It's what's represented when you see this brand, the Giveback Realtor, a project that I care deeply about and hope that you will be part of. And with that, let's get back to the interview. Excited to have you on.
I'm excited to be on. Thanks for inviting me.
So we have some interesting circumstances happening in the market. You've been tracking. Rates seem to be going tick, 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 and buyers and sellers are frankly freaking out. They are either not coming to the market, or they thought they had their toe in the market, think they're going to wait for rates to come down, and it's not going that way at all. So the conversation's been shifting, I've noticed. Right. Lots of buyers are asking or very curious. Their ears kind of perk up when they hear the term seller carryover, seller concessions. I've talked to another lender. There's some really creative programs that are now being offered by the different lenders. We're here to talk to you about all this whole landscape of things to keep the real estate market going in these cold months.
Literally.
Yeah.
There is an awful lot of changes that are happening out in the market, and getting clients to feel comfortable in buying in this market. And I really go with the phrase of marry the home and date the rate, because that's what this market entails right now. The rate is not something you'll live for over the lifetime. It's something that you're going to have temporarily until a better market presents itself.
So playing devil's advocate on that, how long am I going to be dating the rate? Like, could it be like 5 years?
I don't think so. Not with the industry's facts out there right now. I think that you're going to be dating the rate for another year. And then I think that there's going to be some opportunities going into 2024 to obtain a lower interest rate. And but there's some mechanisms today that can get you into a comfortable rate in the mid fours for the first year, and then go into the mid fives. So it takes out the risk of an adjustable rate mortgage, but it gives you some clarity and some ability to budget as a buyer. But I think that, you're probably going to date this rate right now for about a year and see what the market presents itself. Now, it could be as soon as 6 months, and we've heard that and seen that before, but that's a great possibility. But you're at least going to date the rate for 6 months to a year.
I'm thinking back to, I guess, November of last year. So it's been about a year when the tightening really started to get felt, and the market, it was, again, in tandem with fall, but I was just new to the industry at that point as a real estate agent. And I remember the conversations among agents were kind of anxious, right? Like, what does this all mean? And, kind of the top of the brokerage at the time was just like, saying, hey, we're going to get through this. We're going to come spring, rates are going to come down. We're going to have the soft landing. And we're in October, the end of October, pushing November again. And that does not seem to be where we are. It seems like things are still climbing up. So can you talk a little bit
Yeah.
about why you're feeling really confident that another year we're going to start to see this taper? What's on the horizon?
Well, and you are right. Last October, we were in the 5% interest rates. But in the buyer's mind, they were still hearing or seeing a lot of their friends had gotten a 2 or a 3% interest rate. And that's where the comfort level fell. And we were told as an industry that we would see rates probably in like 4.75% by March of 2023. And that didn't happen. And there's a lot of reasons that didn't happen. And one thing was the economy with the inflation. They were trying to get the inflation under control, and the present administration kept on raising rates up. That was one tactic that could have happened. Now they feel like they're going to do one more before the end of this year, and then they're going to calm those interest rates. So I think overall, the market intelligence out there is that we should see a decrease of rates somewhere. That may be May, it may be June, it may be July. But right now, a lot of what we're doing is making buyers feel comfortable in the payments that they're going to have for the next couple of years. So it creates a safety net. Instead of having a rate of 7.75%, you can start off a rate at 4.75%, and you can get to that affordability payment. And then the next year you'd be at 5.75%. Now you do this through a seller concession, but a lot of sellers are trying to reduce their price, and we're trying to educate the market not to have the buyers come in with too low of an offer, but accept the higher price offer that the seller is asking for, but have the sellers also upfront acknowledge a seller concession, because a seller can give up to actually a 9% credit. But the typical is 3 to 6%. And overall, I think that this is going to buy the buyers an opportunity to have a lower rate for the first 2 years without feeling the pressure or the stress over, well, is the rates going to come down in 6 months or 1 year? It really gives them comfort level for the first 2 years and even 3 years, because right now with the rates topping close to 8%, you have to come up with some type of affordability to make the buyers and the sellers comfortable. But overall, the economy is the economy, and my crystal ball, I say, broke during COVID. So honestly, we could see these rates higher for a while. Overall, industry and economists are not stating that. They're saying it's going to be probably another 6 months. But like I said, if you can get comfortable in a payment that you feel is affordable for the next, 1 to 2 years, then you are going to be able to date the rate and look to refinance. Additionally, a lot of the banks know that we're giving higher priced loans right now in the current market. And because of all the economists, we know that we're going to be in a refi market. So a lot of the banks are trying to come up with creative solutions to actually have these clients be long-term clients, as opposed to us losing them in 6 months or a year when the market does come down. So North Point Bank offers for 3 years after you close, we will waive all your bank fees to refinance and stay with us as your current lender. So I think that also would show you that overall the banks also believe, and some banks are out there with 1 year, some banks are out there at 6 months, but that's pretty aggressive for North Point Bank to come out at 3 years from the date that you close, saying we will waive all of your bank fees if you when you refinance with us. It's not if, it's when.
Yeah, I mean, I've heard like there's I had somebody else on the podcast. They were talking about, you know, they're branded. These programs are branded.
Yes.
The one that I heard was rate rebound, but then, you know, you talk it's but in concept it's like a very similar thing. It's just understanding that capital is expensive right now. People that were gold star, gold standard affordability profile at 4% are like
Hmm.
not anymore.
Right.
And that's probably really uncomfortable. So that's good to know. Like, what is I've actually learned that in this call that the seller could offer up to you said 9%, 10%.
9%. So so if it's a government loan, so if it's FHA, VA, USDA, you can always have a 6% seller concession. So seller concessions vary by loan type, loan to value, the amount of down payment somebody's putting down. So on a government loan, it's 6%, whether it's FHA, VA, or USDA. If it's a conventional loan, a conforming Fannie Mae loan, then it's 3% up to 5%. If you're putting 5% down, the seller can give up to 3% concession. If you're putting at least 10% down, then you can have up to a 6% concession. However, if you're putting 25% down, then you can have a 9% concession. Now, all of those concessions are for owner occupied loans. For an
Okay.
investment property, it's capped at 2%. So, on all conventional programs, regardless of the down payment.
So look, so let's to work with some numbers here. So we're
Mm-hmm.
looking at just keep it simple, $1 million property, because you
Right,
know the $1 million listing is awesome. Um, and so 25% down would be
right.
$250,000. So
Mm-hmm.
that puts us at
750.
750. Okay, 750. So the 9% is on that 750
No, it's
from a
on
million.
the purchase price. It's on the not.
So it could
It's
be
on the
so
million.
so that'd be 90,000 up to $90,000 in seller concessions. What is
Yes.
that? So on that loan of a $750,000 loan, what does that $90,000 do in? I'm going to use some terms, people. These are really important, especially in the coming market. These buy downs, right? You're going to talk a little about 2-to-1, 3-2-1, permanent buy downs. There's different options
Right.
that are mechanisms to, you know, alleviate the insulate the buyer from the real world interest rates, which I think as of today are like 7.79% where we are. Um, so taking that figure, let's round that down to 7.5, right? What does a $90,000 in seller concessions get you?
Yeah.
Yeah, can you talk a little bit about that?
So let's say we're talking that at a no point loan. So a no point loan means 0 points, right? You're at seven point
Wait, what does that mean?
no.
I've heard these points, like basis
Yep.
points. Is that the same or?
So no
Okay,
points. Points are 1% equals 1 point. So if you had a $750,000 loan amount, 1 point would be $7,500. Okay. So if you hear about 1 point, that's 1%. Okay.
of the
1%
principal.
of the
Okay,
loan amount. Okay.
okay. Mm-hmm.
So if you're doing a 0 point loan, right, basically you're saying, hey, and by the way, points are tax deductible in the year you purchase a property, different than on a refinance. On a refinance, if you pay points on a transaction, so you pay points to obtain a lower interest rate for the life of the loan, okay? But if you pay points on a refinance, it's amortized over the life of the loan. So if you took a 30-year loan, you have to divide whatever you paid in points over the life of the loan. So a lot of people on a refinance would go a 0 point loan. Whereas on a purchase, you get the immediate benefit in the year you purchase the property. So especially right now, we're talking at the end of October. So somebody purchasing a house right now today in today's market and they close before December, I'm going to be able to take that as a tax advantage off of my 2023 taxes, which I can file as soon as, the end of January. So you get an immediate return based off of paying points. And it's not dollar for dollar, it's based off of your individual tax circumstances, but it is tax deductible.
Can that be deferred? Like, can I take part of that benefit this year and kick the rest? No. So it's kind of a take it or leave it in the year.
Yes. So if you had a high income year, let's say you were paying, you received a lot of commissions and you're looking for a way to minimize tax liability, then paying points is a way to do that, because that is looked at as tax deductible. So when you're looking at today's market and you say, okay, a 0-point loan is around 7.875, right? If I had a 3% seller credit and I applied the whole 3% to the interest rate, so I'm not going to apply it towards escrow and title closing cost, I'm just going to apply it towards buying down the interest rate, right? Then I'm going to get to a rate of around probably 6.875, right? Now I could take that same 3% credit and I can do what's called a 2-1 buy down. And a 2-1 buy down is roughly about 2.6 percent in cost. So when I do that, and let's say my rate is, as we said, 7.875, I can get to 5.875 the first year, 6.875 the second year, and then I don't reach my full interest rate of today's market until the third year. So 7.875 would be my interest rate in this scenario from the third to the 30th year. So that creates a below market financing opportunity for your buyer just by the seller creating a 3% credit. Now, let's take that a little bit farther, and let's say that seller gave a 6% credit. Now, in that situation, if I took that all towards the interest rate, now instead of having a 6.875 rate, now I'm looking more about, now if I was going to do a permanent buy down, which means if I'm going to take the whole rate down, then I can get that rate to about 5.25, right? So 5.25, I pay 6 points, I get that rate for 30 years, right? But the other way you can take that 6% credit is by doing what's called a 3-2-1 buy down. So again,
can I pause you right there for a quick second, because I'm having a little bit of a mini aha moment. I want to be sure that it's right. Okay. So back to our example: $1 million home, $750,000 loan, $90,000 in concessions. If I take that 90,000, divide that by the say 7,500, right? That's going to give me the number of points that I could buy with that $90,000 seller concession. Is that right?
Not exactly. It's not a dollar for dollar math like that. It is a market math. So depending on what the interest rate is, each interest rate is called a coupon on the market, right? Those coupons trade at different market values. Okay.
So how do we bring it into like this illustration with like the 7.5%?
As a rule of thumb, for every eighth you can reduce the interest rate, so every 0.125, that will cost, this is a rough number, but it will cost 0.625 in points. Okay?
So every 0.125 costs 0.625.
25 in points, correct. Okay. So, but when you look at that same 90,000, we can couple that with a permanent buy down and a temporary buy down. So let's say that we so it's going to cost 4 points to do the 3-2-1 buy down. So we have 2 points left over, right? So let's say we buy that rate down from 7.875. Let's say we buy it down to 7.25, right? Now we have the first year at 4.25 interest rate. The second year is at 5.25% interest rate. The third year is at 6.25% interest rate. And the fourth through the 30th year, you get to 7.25%. Now, this loan is better than any adjustable rate mortgage out there on the market. And let me give you a little bit of information on that. We are going to start seeing adjustable rate markets creep into the market as we go into 2024, and they're there today. But if you get an adjustable rate mortgage, you have to remember that the adjustable rate mortgage is still a 30-year loan, but it's fixed initially for an initial term. And that initial term can be 5 years, 7 years, or 10 years, right? So here's the facts on an adjustable rate mortgage. An adjustable rate mortgage, let's say you had a 5-year, so it was a 30-year loan fixed for the initial 5 years, right? Then you would have an initial cap after the 5 years. The first adjustment, you can go up a full 5%. So let's say you started at 6%, you went up 5%. Your first adjustment could be as high as 11%. Then after that, that adjustable rate
Wait,
mortgage.
what?
Yes.
You just 11%?
Yes.
What is this? The 1970s? Like, just kidding.
And that's what people are thinking. They're thinking, oh, especially on a jumbo mortgage, right? They're thinking, oh, I'll just get an adjustable and I'll do it as 5 years. I'll get the lowest term fixed, so I have the lowest interest rate. But don't be distracted by the lower interest rate, because you have to understand the full terms. Yes, that rate's fixed for 5 years, but what if we were in a rising rate interest rate at that time, right? Your first adjustment at the end of your fixed rate period, so let's say that's 5 years, that cap is 5%. You can go up 5 full percent in the first year of adjustment. Then following the first year adjustment, right now, those rates can adjust every 6 months, a maximum of 1% per 6 months. Now, you also have a lifetime cap on that, which is also 5% from your initial rate. But now let's compare that to that 3-2-1 buy down that I talked about. Remember that you were at 4.25%. The highest rate you could get is 7.25%. Those rates and those payments are fixed for 1 year at a time, so you can budget to that 1 year at a time, that increment of 1% in interest rate increase per 1 year. But you, in theory, have the highest rate you can go up is 3% from the rate you start at on the 3-2-1 buy down. Much better option than a 5-year adjustable rate mortgage.
Well, maybe unless you're feeling really lucky and you're wanting to speculate on interest rates over the next 10 years, and
right.
no, that's really interesting. So the buy down is really the difference is you have the certainty for the term of the instrument, as opposed to subjecting yourself to fluctuations in the market, which may or may not be positive. Like, we could be totally wrong, and interest rates are not low for just a year, or do not lower in a year. We could repeat the 70s potentially. We don't know.
Correct.
And so this buy down gives you more certainty in that environment. So I kind of play this out where it's like, well, if interest rates are going to go higher than they are now, well, then it's actually still a better time to lock in the rate, right, today. And if they're going to be lower, then you refi later on. So, like, it's
yep.
It's kind of the way to think about it.
Our market and our world is cyclical. What comes up will go down. What goes down will come up. We've seen this in the past. We'll see it in the future. And as a consumer, the good thing about us is that we have so much social media around us. When rates go up, we hear about it. When rates come down, we hear about it. And your loan officer, whoever it is, it also puts you in a database where we're constantly trying to keep you informed of market analytics, as well as your realtor. Your realtor is your best friend of keeping informed into today's market environment, right? And to your point, yeah, we like I said, my crystal ball doesn't work any longer. So
Yeah.
we,
I mean, there's some really interesting, macroeconomists, and I'll just comment on a couple that I follow because I nerd out on that. But it's like there's sort of three orders of separation between the macro factors
yeah,
and local real estate market dynamics.
mm-hmm,
It takes a little while for all that to kind of filter through and then be felt by our consumers and clients.
right.
But Raw Paul is really, really great. He has some really interesting studies on how the cycles relate to the debt cycle post
Mm-hmm,
2008 and how things have really kind of come into lockstep after that big reset. So
yeah,
something to check out for you viewers that are interested in going down the rabbit hole of the macroeconomic story. He calls it the theory of everything. I don't know if that's necessarily accurate, but it is an interesting perspective,
yeah,
and kind of be able to look at the lens of real estate through that. Can we pivot for a minute and talk a little bit about this? Probably for you, a four-letter word, but seller carryback, right? Seller
yeah.
carrybacks kind of are a sidecar. For those of you that don't know, there was a period of time back in the 70s and 80s when interest rates were double digits. We're not there yet. I talk to clients and they remember fondly of these times when interest rates were so high and they had to buy their first house and it was 13%. And in that environment, what emerged was a sort of a secondary market where owners of property would hold the note. They would act as the bank for new buyers. And this happened because banks had to qualify people at these higher rates, and just I'm guessing a lot of people didn't make it. And so real estate still has to get sold. People still have life changes that cause them to move and sell and reorganize their finances. And so the world is still turning, and these seller carry contracts and constructs kind of emerge as a way to enable people to negotiate with each other and to define the terms. This is starting to be talked about again today, but it's important to remember that we are not in the 80s. We have been in an industry that has evolved with technology. It's evolved. It's much more interconnected with markets in ways that it wasn't back in the 80s. We have credit in ways that didn't exist in the 80s to the consumer. And regulations. We have 2008, which completely rewrote the book on how lending is done in the real estate industry. And so in this new environment, we really need to think strongly about how these tools apply in the world. Some of them worked, and some of those that were used are not even allowed to be used in certain markets. And Kim will be able to speak to that. So yeah, if you can talk a little bit about kind of your view on seller carry, where it applies, what risks are there. I mean, I know we were talking, in the last couple days about a deal that I'm working on, and buyers asking about this, and
Mm-hmm,
we don't know. There's clients still have mortgages, and there's this product. What is it called? The all inclusive.
right.
Is that what it's called? So this all inclusive is kind of interesting, but is it even allowed? I don't. We're still getting to the bottom of that today. So Kim, take it away, and I'll ask questions along the way.
Yes. So, in the traditional sense of a seller carry, we've seen that what is allowed is if a buyer doesn't, and we'll take this in a little in pieces. So, let's start the first place that a buyer comes in and they really would like to have purchased this house, and let's say it is 700,000, and they don't have 20% down. Well, with a lender, you can do that loan with 3% down. However, then you have mortgage insurance. Okay. So the traditional seller carry was you would still get a traditional loan for the first 75% or 80% loan to value, whatever that would be. And then the buyer would say, hey, I'm going to come up with 5% of my own money. But the seller then could say, hey, I will give you the 15% so you can avoid mortgage insurance. So there would be a first mortgage that would be held by the bank, and there'd be a second mortgage, which would be seller carried back, and that might be 15%, might be 20%. The reason this all started was to avoid private mortgage insurance. It allowed houses to be more affordable. Now, in current times and in our current market, we do have a lot of sellers out there that have quite a bit of equity, or they have properties that are free and clear. Now, when a seller does a carryback, it does do one great thing for them tax-wise. If they do a carry, then they do not have to report capital gains until after they get paid back on the amount that they carried, right? So let's say somebody had this same $700,000 house and it's free and clear, and the seller isn't looking to purchase another home. So this money was going to sit there and they were going to invest it in some way, somehow, right? A lot of sellers today can go, hey, the banks are out there charging 7.75%, 7 7/8, 8% interest rate. And they could choose to say, I will be the bank, and I'll offer a seller carryback financing, and maybe they'll offer it at 5%, maybe they offer it at 6%. If the seller is willing to carry back the mortgage for the new buyer, they set their own terms. They also set their own qualifying. So they are going to be less stringent than what the banks are out there, right? So that seller now becomes the bank, right?
Well,
So
isn't
they
it?
just,
But there is services, right, that allow you to do the vetting, right? Like you can
yeah,
go to a third party. Like, I mean, in the rental market, you do that all the time. You do credit checks for tenants.
this,
There's
yeah,
servicing companies, so there is infrastructure that doesn't put the burden fully on the
yeah.
seller.
And not only that, but a lot of realtors will partner with a lender and say, can you still pre-qualify this buyer, right? And we can still go through that process, right? But ultimately, at the end of the day, the the seller, if they're doing a carryback on that mortgage, they're going to be the sole decider of if they approve you or not. The same thing as if you're going through a bank. Each bank will go through their own underwriting mechanisms to decide if you qualify or you don't qualify, right? So the seller can offer in today's market or in any market the opportunity to, hey, I have a house free and clear. You're going to pay me 700,000. I'll have you put down, let's say 20% or 10% or 5%. They determine the terms, and then they say, hey, I'm going to do it at 5%. Sometimes a lot of sellers will do interest only. Some of them will do principal and interest. Um, but you are getting a seller carried back mortgage. The seller is creating their own financing and they're creating their own terms on that loan. A lot of times it won't be a 30-year loan. A lot of times the seller will say, I will give you 5% interest and it's due in 5 years, right? So you have to refinance at the end of that 5 years. There's going to be a term that they want their funds back, right? So that is a seller carried back.
So,
Now
so
there's
just to be
this,
clear, the loan itself is amortized, can be amortized over 30 years, but then it becomes due in 3 years or 5 years or 1 year or whatever the seller
correct,
wants.
at
Okay.
whatever the sell, and so that's considered what's called a balloon payment. So you have to make sure if you're going to take a seller financing, there's also economic obstacles that could be in your path also. Like, do you have a job? Can you afford it? Can you now qualify based off of traditional? So you have to understand that those seller terms are going to be different than a 30-year fixed, fully amortized loan. Typically, they will be either principal and interest, but what I've seen is mostly interest only. The benefit to the sellers is that they are earning a higher rate of interest than they may or may not be able to obtain at through a CD or a money market or something of that nature. Now the sellers also have the risk on what if the buyer loses their job, or what if we're in a declining market, or something of that nature. So if that buyer ends up not paying, then the seller now has the legal cost of doing, the foreclosure process, and that falls on the seller. So there's benefits to the buyers and there's benefits to the sellers, but there's also the other angle of what happens if the seller can't, or the buyer can't continue making the payments. Is the seller modifying that? Are they in a situation to say, hey, I'm going to decrease the interest rate? Are they going to do a modification? What happens if I can't qualify at the end of the 5 years and now I can't sell, now I can't refinance? Does that create an opportunity that now I have to sell that property as the buyer, right? So you have to really focus on the terms, whether you're getting a loan from the bank or whether you're getting a loan from the seller, because those terms are negotiable, but the seller's going to set something that's comfortable and economical and beneficial to them.
Well, I mean, yeah, because they are assuming a certain risk,
Yes,
right? But I mean, it's not just default; it's also
correct.
what happens if the buyer moves in and starts to move walls, and then they lose their job, and now you've got
Right.
property damage, or like how do you even mitigate that? As I
Well,
mean, that to me seems like a nightmare scenario. As when you get into that,
and
like,
and that is very true. You could go into a situation that you could be taking back a house that's very different than the house you sold as the seller. The other new term that we're hearing, and I heard this back in the 80s, I experienced it in the 80s, it's called an AITD, which means an all inclusive deed of trust. All I have to say on that is you really need to beware. So this is where, let's say we take for that same situation this $1 million house, and the seller, because of recent years, they refinanced down to a 2.5% interest rate. Let's
so
say,
I want to share my screen because I actually have an illustration of this.
okay,
And if it's okay, and I kind of want to go through it if you could and talk a little bit about it because
yeah,
we can show
let's.
where it is. So, sharing screen. Let's do this one. So this is based on a spreadsheet that I put together, Kim. It's the numbers have all been modified so they don't apply to any particular deal, but in
Right.
principle we're talking about the same thing, and I'm going to go ahead and kind of just give you a quick highlight of what I have here. So here's that list price of $1 million, down payment 20%, 200. The buyer loan that the seller would be carrying would be 800,000, and then that results in this payment of roughly $4,800 a month. Now the seller has this existing loan, and I think this is what you're getting at. The all-inclusive portion of it is the seller has this existing loan balance of say 350,000 at 3.25%. So they refinanced during COVID years when it was cowbell and the money was coming out and we were trying to stimulate the economy. They refied, which
Right.
a lot of us did. And so now you have this scenario where you've got these two kind of partitions or tranches of debt. You have the equity position, which is the amount of the list price less the amount of debt, which I think we have $1 million less 200,000, it's 800,000 less the amount of debt brings us to $450,000 equity that is being used to finance the property. And then you have the $350,000 that is still being owed to the original lender on the original loan. And if we're loaning to the buyer at 6% because rates are 7.8, then there's a spread. So for the equity portion, the seller would get the full amount. And for the amount that's still being owed, then you take the difference, 3.26% minus 3.25, and you get 2.75%, which would amount to these payments. And so the punchline is that in theory, if everything worked well and this was feasible and legal and all of that, that you would be able to achieve a return on the equity on that $450,000 of 7.35%. Because you're getting all of this interest over, in this case, this scenario is 3 years, and then this scenario is 5. So this is like an illustration just for us to talk about and kind of bring it home how this relates, what the issues are, and whatnot. So I'll leave this up for a minute,
Yeah.
but Kim, please take it away. If you want me to highlight anything, just let me know.
Yeah. So the caution is that the good news is that people have refinanced and they have obtained these lower interest rates, which is great. And they have this ability, and they also have a lot of equity in their property. So the interesting part of this is that right now out in the market is that people are saying, hey, we can create an opportunity to do seller carryback financing. But what happens is the seller still has their mortgage, and the mortgage that they have will not be paid off. So, but they offer to create an opportunity to carry back a mortgage for the new buyer, and the buyer would pay the seller, and then the seller would continue paying their mortgage. And that's called a wrap mortgage or an all inclusive deed of trust mortgage. And the problem with that is that, number one, the mortgage that the seller had never gets paid off in full. So that loan stays on record, and the new seller carried back loan also is recorded. So now you have the original loan plus the new loan, both recorded on this property. The problem with that is that the first loan that the seller is continuing to pay is a fixed rate loan, which is not assumable. And the bank hasn't allowed they haven't approved of this transaction. And because they haven't approved of it, it makes it questionable if it's legal. I know in some states, an all inclusive deed of trust sale is not legal.
Is that only because the bank did not permit it to happen?
It's because the bank originally
The
wrote,
original lender, sorry, to be clear,
yes,
the original lender has not given express approval for this wraparound to be basically included in a secondary product.
correct. The original lender has not approved that the original loan was assumable. And so they also didn't approve that. And in the mortgage document, in the original mortgage document, it says that if title changes, this loan is not assumable. This mortgage must be paid off. So if you go with that thought process and that legal document that all parties agreed to when the original loan was approved, now you're recording another deed and you're selling it to a person and you're saying, hey, I'm going to do a seller carried back loan on this. But what happens here is the first lender didn't approve that. Now let's look at this in a situation where the seller becomes ill and can't continue paying their mortgage, right? The buyer has their mortgage, but this other lien is also still recorded against this property, right? So there's still a financial responsibility to this property that first mortgage needs to be paid according to the terms of the sellers when they finance the property. So
Okay, so
one,
two questions before you continue, because I don't want to
yes.
forget them, and I'll do that sometimes. So
Mm-hmm.
it sounds like the two issues that I'm hearing is one, if the seller, that means the one responsible for paying the original loan,
Right.
becomes incapacitated and is
Mm.
unable to continue paying, that's a problem. And
Right.
the second issue is the legality or enforceability, because it's just not, there was no permission by the original party. The original lender is not given express permission. But
Correct.
is it so to for these two issues? Is it possible then that a seller, you could get permission from the lender to do this? Just kind of like thinking back to the days of when you'd had to do short sales and you have to go to the bank and get permission in order to do it before you actually did it.
It's
Is there is there a similar mechanism for that? And then the second question is, my understanding is that there are services that would manage the payment. So the
mm-hmm.
buyer pays third party
Right.
Q to their mortgage, and then that kind of custodian, distributes the payments as needed, so that the seller is not, the point of failure in that whole chain.
Well, and you are correct. There are services out there that will escrow the entire arrangement, but you have to go through first that first detail, right? I would encourage anyone who's going to go into this type of a situation, seek an attorney to make sure that what you're about ready to engage in is viable in your state. Okay, because this is going to, but the seller's note will state that the loan is not assumable. Now, this does not. Now, if the seller's loan happened to be an FHA loan, those loans are assumable, and
Right. But
and
those don't
a
apply everywhere. Same thing with VA, like not, or
correct.
USDA loans, right?
Yeah,
Not
well,
every property can have that.
yep, VA is only assumable by another veteran. The problem about an assumable loan is that the bank never releases the original borrower. So they don't fully release the liability from the original person that borrowed. They will
Ooh.
allow the loan to be assumed, but they don't release the liability.
Well, I guess it's a coincidence that we're talking about this in the season of Halloween, with all these skeletons in the closet and ghosts that could come back and haunt you.
Right.
So that's interesting.
Yeah.
That's a whole another show. So maybe we do need to have a series
Yeah.
of creative financing. I mean, I'm really hoping that you viewers out there are finding this to be, a value. We've been going for, gosh, 45 minutes. It feels like a
Right.
breeze. But I know that, when I got into the industry, uh, buying my first house, I did not know anything about this. It was way over my head. And in these times when there's a lot happening really fast, hopefully you guys are getting a ton of value out of this. I know I am. So thank you, Kim. But anyway, back to it.
Yeah. Well, I appreciate obviously you having me and us talking about this, because it's not about, there's going to be some very attractive offers out there, right? And they're going to be very appealing to sellers and buyers. A seller wants to sell their house. It's been sitting on the market for 100 days, and they want to continue with their life, and they want to move across the country, and maybe it's a job change or whatever, and they're trying to get creative. Definitely work with a realtor that's knowledgeable, work with a financial advisor that's knowledgeable in the market. Yes, work with Stephen, and who's not afraid to ask the hard questions, right? It's like,
Yeah.
hey, this is a great idea. I just heard of it. Let's vet this process. I was in financing when this AITD came out in the 80s, and I saw a lot of people lose their houses, and I saw a lot of heartache. Just fully vet, get an attorney involved, get the right real estate experts are involved so that you can protect your interests. Because at the end of the day, our homes are our biggest investments. And whether it's your primary home, a second home, or an investment home, and you're building wealth, I would say you want to create that wealth mechanism. And you want to work with a realtor that is, knowledgeable in the market and that can help you grow that wealth. And this is a moment in time. This is a blip in the market. This is a today issue. And that's why the option of marry the home and date the rate, you want to build your wealth. And right now with the rates higher, the market is a buyer's market. The
Yeah,
buyer
for
can go
sure.
out there and buy a property and not have such a competitive situation where there's 20 other offers on the same property, and you can buy a home of your dreams and start investing in your wealth, but invest the right way. Invest
You
in
know,
the
it,
right.
it takes, I mean, this goes to other markets too. It takes kind of a contrarian mindset, right? Like
Yeah.
the sort of the collective mindset around market dynamics today is there's a little bit of panic. There's a
Hmm.
little bit of like, oh my God, it's gonna we don't know how bad it's gonna get. And we don't know, but usually people are feeling that way when you're getting to like the worst scenario.
Right.
And there is this kind of ability to sort of step back and be like, let the sort of storm be an opportunity for you. And
Right.
the way that I look at it is, it's like the real estate are kind of like physical bonds, right? You have this like house, and then
Right.
there's this interest rate component, and then you've got the list price. And if
Yes.
interest rates are going up, well, the list price is going down because
Yep.
there's an affordability component. And so if you can step in bravely and figure out how to make it work for the period of time that the rates are high,
Right.
you're going to benefit from the low price during that period of time. Wait it out, get the seller to offer concessions or get creative about how you do that. Hang in there in the market. The rates are going to float back down, and you've locked in that lower price.
Right.
And then, if you're able to hang in there, you're going to be able to lock in lower financing.
Yep.
Um, because
You're
it's
built.
not going to be a straight line up to, if we are going to go to 15%, it's not going to be a straight line. It's going to
No.
go up, it's going to go down, it's going to go up, and we'll meander. And so there's still opportunity to better the situation from where you are, you
Yeah,
know?
and right now you're building your wealth. And there's no better asset that you can have than real estate. And ultimately, that house that you're buying at $1 million today is actually going to creep up too, right? It's going to go to that 1,000,001 or 1,000,002 and 1,000,003, and maybe that house is a stepping stone for you. But let's not forget that there's one great advantage to higher interest rates, and
Oh, the
that's
tax benefit, right?
tax benefit. Let me just tell you, when COVID hit and we all refinanced down to 2.5% and 3%, we all thought that was great, right? But what a lot of people didn't do was take into consideration they just lost their biggest write off, right? So, right now, if you need a write off and you're in a job that maybe it's commission and you have a higher level of earnings and you're trying to defer some, minimize your tax liability, what better way is it to do it than, buying a property and, getting the interest right off of the mortgage interest, property tax deduction.
And
Like
dare
I
I
said,
say, have the seller pay for it through
yeah,
seller concessions,
absolutely. And
like
and
crazy.
don't be afraid to tell your realtor or the lender, like, I need my payment to be around X amount. Like,
Yeah,
let us help you craft the financing that you need. And don't be fixated on a purchase price, be fixated on the payment amount. We'll help you get there because we're your team. We're going to
yeah.
be your team. We're your advocates. We're not out there just saying, hey, it's one way and it's the highway. Use your real estate professionals, use Stephen. He's very knowledgeable in the market and he'll put you together with, not one lender, but maybe three different lenders that you can really craft out different opportunities to make your right decision, because my right decision is not the same that would be your right decision. So
Well, and
every
that's really
person is different.
that's really the thing. Like I love that you say that we're a team, right? Because there are lawyers, there are appraisers, there are
Right.
contractors, there are lenders, there are realtors. They all have their little kind of specialized view of the market and
Right.
what the scope of their responsibility is, and they know the inner workings of how that fits into a functioning real estate market.
Yes.
And so please leverage, please ask your questions. We are here to help you navigate. This is what we do every day. And most people aren't buying houses, but a couple of months out of their life. Like
Yeah.
you're in real estate transactions, maybe, well, I don't know, maybe unless you're crazy, but 5, 6, maybe 10 times tops. And those periods are 1 to 2 months usually. And we're dealing with transactions all the time and there for the seasons of the market as things change. So
Right.
please reach out, please ask your questions, write them in the comments. I will get back to you. If I don't know the answer, I'll find the right lawyer, estate planner, lender who will. And that's kind of, I guess I just got off a soapbox there. um, yeah, we should probably wrap it up. We're pushing an hour, which
Yes.
it's crazy to imagine, but I really hope you're going to come back and do this again. I know there's a lot more to talk about.
Yeah.
Um, you know,
I would love to.
yeah, it's amazing. And again, if you guys like this, please let me know. Please tell me if there's things that we didn't cover that you need, because we want to be sure you get those questions answered in a way that is accessible, and be that fly on the wall just listening in, because we nerd out on this all day long, every day, and it's just a pleasure to have you listening in. Kim, before we drop, I just want to ask you, so you just moved, you're at North Point Bank. That's kind of a new thing for you here in Bend.
I am.
So can you tell us a little bit about your move, where people can find you, how people can contact you if they have questions, and when they should contact you?
Absolutely. Well, you should contact me anytime, whether you're thinking about buying a house today or a year from now, because we can help you become home buyer ready. So, and maybe that's a credit correction. All of that is something that we can help you with. So, my phone number is 818 652 5652. My email is kimberly.patterson@northpoint.com. And Stephen can provide that in the comments area. But I also want to tell you guys one other thing. We've been able to get more people financed recently, where when the market was down and we were down in the 3%, the banks were highly selective on who we were approving. Right now, you guys have the benefit of the banks being flexible also. So
Wait,
if
so tell me more about that, because that's counterintuitive to me, right? Like higher interest rates, wouldn't that
yep,
mean like more stringent qualifications to get a loan?
no, I let me tell you, I'm dealing with one client right now. That client has had probably 7, 8 jobs in the last 2 years. So not the stability that we would normally look for. However, they the underwriters were able to say, you know what, we'll do this transaction. We just want a letter of explanation to explain why have there been so many job moves. So there are things that right now the lenders are doing which they wouldn't have done when there's 200 people a day trying to get a loan, or if there's 20, right? We are in the business, and this is important too. Banks are in the business to lend money, right? So we want to become as creative and also minimize the risk while we're doing that. But if we can make a good transaction to a person, and maybe it's that your credit score is low, don't worry about that. Don't think that you have to have a 700 credit score to purchase a home. You don't. We can go all the way down into the 500 range to purchase a home. You may need a look more of a down payment, right? But there's all types of options. And in the Oregon market, if let's say you don't have a down payment, there are so many properties out there you can purchase with no money down. Call Stephen for details. You can do a USDA loan. There's so many options. There's different down payment assistance programs. Right now, if you were on the fence and maybe it's because you've been denied in the past, give it a try again, because the banks are becoming a little bit more flexible. And but there is a huge affordability component to this. And with the assistance of a lender and the assistant with the realtor and then a cooperative seller, we can get your payments down and manageable to where your budget is looking to be.
Yeah, and I'm going to tell you right now, people that are selling right now, they're motivated. Like they will work with you. It's changed from when you have a hot market and it's a bidding environment. Sellers are picky. They're like, I don't like this because of this, and I ain't gonna do that. And now, it's like, how do we make this happen? We get it. It's painful out there. What can we do to work together? And so you're going to find it's a very different environment and much more, people are banding together. Buyers and sellers are working together to make a transaction happen. It's kind of interesting, representing one party, because it does feel so collaborative, and that's such a change from an environment where, you're really trying to be close to the vest and keep your client's interests at heart. Like there's more openness, it feels like.
Yeah.
And bankers like Kim are the ones that we go to get creative about how we can make a product work. What's the level of seller concession? And we haven't even covered all the things. This is literally scratching the surface.
Right.
And for those of you that have been looking in the market and felt this really dramatic change over the month, just remember, stay in there, but keep talking to lenders and to your professionals that are advising you, because they will advise you as the market changes and help you get to that next step. Make the most of the opportunity now, because when the market does come back, which it will, you don't want to look back and regret that you've had to bring an extra $150,000 to close because you're competing
Right.
with three other people to get a low rate that doesn't give you a tax efficient strategy. Like, just face the discomfort and stay in the market, and we'll help you.
And then the sellers, don't just drop your price. Just
Yeah.
allow your realtors to guide you. Have confidence in the market. Have confidence in your real estate professional. Have confidence in Stephen. He's going to represent you because if you drop your price, you're affecting the entire neighborhood.
Right.
Keep your prices higher, but offer these concessions. That will help not only you, it will help you get a viable buyer, but it will also make all your neighbors still be your friends.
I need to have you actually. I'm gonna follow up with you offline about an actual client dealing with an actual situation where we need to have this conversation. I need to bring you in.
Yeah.
So yeah, you guys are watching it happen live. Kim's gonna be helping a client understand this, because there's panic leaving the market, and there's panic trying to sell, and that
Yeah.
panic manifests as, I just want to lower the price before all hell breaks loose and we're at 15% interest rates and all of that. So work with us, we will help you. And I think
Thank
with
you
that,
so much.
thank you for coming on the show and being part of this. I look forward to talking with you again on a future episode.
Sounds good. Well, happy hunting out there, and we're here to help you guys. Contact Stephen. He's an expert in the market, and he will guide you through the process.
Great, thank you. Hear that? Yeah, she's talking about me. Okay, bye.
Bye.
Okay, so we